The entire global economy is floating on a sea of IOUs. As of late 2025, data from the Institute of International Finance showed the total value of all the debt on Earth, from governments, corporations, and households, creeping toward a mind-boggling number: $346 trillion. That's more than 3 times what the entire world produces in a whole year. From the United States to China, pretty much every country is in debt. But that brings up a simple yet weirdly complicated question. If everybody owes money, who are we all borrowing from? Who's holding the $346 trillion IOU that the world has signed? The answer isn't some shadowy group of billionaires or a loan from another galaxy. It's both much simpler and, in a way, more shocking than that. The truth pulls back the curtain on a complex, tangled web of players who hold the keys to the entire global financial system, and by the end of this, you'll understand exactly who they are and how this system holds immense power over your financial future. Section 1. What is this mountain of debt? First, let's wrap our heads around that number. When you hear global debt, we're not just talking about what governments owe. The figures, which come from groups like the Institute of International Finance, or IIF, and the International Monetary Fund, or IMF, are a mix of 4 main buckets. The first is public debt. This is the money governments borrow for everything from roads and soldiers to social programs. As of 2024, global public debt was on track to surpass $100 trillion. The second is non-financial corporate debt. This is cash borrowed by companies like Apple or Toyota to build factories, do R&D, and grow their businesses. The third is household debt. This one's personal. It's the mortgages on our homes, the loans for our cars, our student debt, and the balances on our credit cards. And the fourth, which is often left out of the conversation, is financial sector debt. This is debt owed by banks and other financial institutions themselves. Together, these 4 make up that colossal global IOU. Now, you might hear different numbers tossed around: 324 trillion, 338 trillion, 346 trillion. That's just because different groups track it a little differently and update their numbers at different times. But no matter how you slice it, the trend is crystal clear. The mountain is getting bigger. The gut reaction to all this is naturally alarm. If you or I were trillions in debt, we'd be in a world of hurt. But here's the first critical thing to understand. National debt isn't like your personal debt. You and I have a finite lifespan. We have to pay our debts back. Countries, theoretically, don't. They don't have a retirement date, and they can do something we can't: just keep rolling over their debt and, in some cases, literally print the money to pay for it. So if governments aren't really planning to pay off the debt but just keep paying the interest and issuing new debt to cover the old stuff, who's on the other side of that deal? Who's buying it all? The answer is realizing that one person's debt is another person's asset. A government bond is a liability for the government, but for the person or institution who buys it, it's a safe, interest-bearing investment. And by following the money to see who owns these assets, we find the world's true creditors. Section 2. Unmasking the lenders, a world of creditors. The list of who owns the world's debt isn't one name, but a whole portfolio of players with different motives. Let's break them down. Player number 1. Domestic private investors, the silent partners. So, who's the biggest lender? The answer might surprise you. For most countries, it's their own people and institutions. Think about your pension fund, or the insurance company you pay every month, or the mutual funds holding your retirement savings. What do they all have in common? They manage enormous pools of money and have one main goal: protect that cash and make it grow, safely and predictably. For these huge investors, government bonds are a perfect fit. They're seen as one of the safest investments you can make, backed by the full faith, credit, and taxing power of a national government. A 10-year U.S. Treasury bond, for example, offers a steady, predictable return. That's exactly what a pension fund needs to make sure it can pay its retirees in 30 years. These private players, pension funds, insurance companies, and asset managers, are the quiet giants of the debt market. So, in a very real sense, if you have a pension or an investment fund, You are a creditor to your own government and to others around the world. Your retirement security is directly tangled up in the stability of this debt system. Player number 2, commercial banks, the foundation. The next big lenders are the banks. Just like pension funds, banks have a lot of capital they need to put to work. When you deposit your paycheck, the bank doesn't just let it sit in a vault. It uses that money to make loans and buy assets, and a favorite asset is government bonds. For banks, holding government bonds does a couple of things. It's a source of steady income from the interest, but it's also a crucial part of their risk management. Regulators require banks to hold high-quality liquid assets to make sure they can handle financial shocks, and government bonds are the gold standard. In the U.S., commercial banks hold trillions of dollars in treasury securities, constantly buying and selling, providing the liquidity that keeps the whole system moving. Player 3, the government itself. The right pocket owes the left pocket. This is where things start to feel a little weird. A huge chunk of a nation's debt is often owed to itself. In the United States, this is called intragovernmental debt, and as of late 2025, these holdings were hovering around $7.5 trillion. How does that even work? It's basically an accounting trick. Think of government trust funds, like Social Security. For years, Social Security collected more in taxes than it paid out in benefits. By law, that surplus has to be invested in special U.S. Treasury securities. So, the U.S. Treasury borrows from the Social Security Trust Fund, and in return, Social Security holds government debt. It's an IOU from one part of the government to another. While it's real debt that has to be repaid for future retirees to get their benefits, it's different from debt sold on the open market. It's like moving money from your right pocket to your left and writing a note to remember to move it back. Player 4, central banks, the game changers. This is where the rules of money really start to bend. Central banks, like the U.S. Federal Reserve, the European Central Bank, or the Bank of Japan, are special because they can basically create money out of thin air to buy their own government's debt. This process got famous after the 2008 financial crisis and the COVID pandemic. It's called quantitative easing, or QE. In simple terms, to juice the economy, a central bank creates new digital money and uses it to buy government bonds from commercial banks. This does two things. First, it floods the financial system with cash, encouraging banks to lend. Second, by buying up so many bonds, it drives up their price and pushes down their interest rate. That helps lower interest rates across the whole economy, making it cheaper for businesses and people to borrow. The Federal Reserve, for example, became one of the largest single holders of U.S. debt, with its holdings of Treasury securities alone swelling to over $4 trillion. Their power to buy debt at this scale makes them arguably the most powerful players in the game. Finally, we get to the part that grabs all the headlines: foreign ownership. There's a common belief that countries like China own most of the U.S. debt, giving them huge leverage. The reality is a lot more complicated. Foreign governments and investors do own a big slice of global debt, but it's rarely a majority. In the U.S., all foreign holders combined own about a quarter of the total national debt, and the biggest foreign holder isn't China. As of 2025, it's Japan, followed by the United Kingdom. Why do foreign countries buy another nation's debt? For countries with major currencies like the U.S. dollar, holding treasury bonds is a way for other central banks to build up their foreign exchange reserves. These reserves help them stabilize their own currency and make international trade easier. If a country sells a lot of stuff to the U.S., it ends up with a lot of U.S. dollars. Investing those dollars in safe, interest-bearing U.S. bonds is just a logical move. So while foreign ownership is an important part of the puzzle, the image of one country holding another hostage with debt is mostly a myth. The ownership is spread out, creating a web of mutual dependence, not a simple power struggle. Everybody is lending and everybody is borrowing. So, we've unmasked the players, a complex network of pension funds, banks, central banks, and investors both at home and abroad. It's a system where your retirement savings help fund the government and where countries invest in each other for stability. It's a universe away from the simple idea of one country being in hock to another. If you're finding this look behind the economic curtain valuable, do us a favor and subscribe to the channel. We dig into these topics every week to show you how the world of money really works. Section 3. The System in Action. 3 very different countries. To see how this plays out in the real world, let's look at 3 very different countries. Case study number 1. The United States, the global standard. The U.S. has the biggest national debt in the world, topping $38 trillion in late 2025. And yet, U.S. Treasury bonds are considered the safest financial asset on Earth. This paradox is all about who owns the debt. Americans are the biggest creditors, holding most of it themselves through mutual funds, pension plans, and other domestic institutions. The Federal Reserve holds another massive chunk, and foreign investors, led by Japan and the UK, own a slice. This diverse ownership has huge consequences. When the Fed decides to raise or lower interest rates, it's not some abstract policy. It directly influences the interest rates on your mortgage, your car loan, and your credit card. The decisions made to manage this mountain of debt ripple right into your wallet. Case study number 2. Japan, the insular giant. Japan is a fascinating extreme case. It has the highest public debt to GDP ratio of any major developed nation, well over 200%. By normal logic, Japan should be in a constant state of crisis, but it isn't. The secret is that around 90% of Japanese government debt is owned by Japan. The biggest single owner is its own central bank, the Bank of Japan, holding over half of all government bonds. The rest is held by domestic banks and the country's huge pension funds. This means Japan isn't vulnerable to the whims of foreign investors. There's no risk of foreign creditors suddenly dumping their bonds and crashing the currency. But this created a different problem. To keep the government's borrowing costs from exploding, the Bank of Japan has held interest rates near zero for decades. This has starved savers and pensioners of any real return on their money and has been blamed for creating a low-growth zombie economy. Japan proves that domestic ownership brings stability, but it comes at a steep price. Case study number 3. Developing nations, the high-stakes game. For many low- and middle-income countries, the debt story is far more dangerous. They often have to borrow in foreign currencies like US dollars because lenders don't trust the stability of the local currency. This creates a terrifying mismatch. Imagine a country borrows $1 billion. If its own currency suddenly loses 20% of its value against the dollar, that $1 billion debt effectively becomes a $1.25 billion debt overnight in local terms. Paying it back becomes brutally harder. When these countries hit a crisis, lenders demand much higher interest rates or just stop lending altogether. This can force governments into devastating austerity, slashing spending on healthcare, education, and social safety nets. UNCTAD reports have highlighted that scores of countries face this choice: pay their creditors or serve their people. It's a stark reminder that when this delicate global debt system breaks, the human cost is immense. Section 4. How the $346 trillion IOU controls your life. This isn't just some academic thought experiment. This global web of debt, with its diverse cast of owners, directly shapes your life in ways you might not even notice. First, it determines the cost of your money. The interest rate on your mortgage isn't set in a vacuum. It's heavily influenced by the interest rate on government bonds, which are the risk-free benchmark. When central banks mess with those rates to manage government debt, it kicks off a chain reaction that decides how much you pay to borrow anything. Second, it affects the value of your savings. When a central bank cranks up the money printer for quantitative easing, it can fuel inflation. That erodes the purchasing power of the cash you've saved. The constant battle to keep inflation under control is tied directly to managing all this public debt. Third, it dictates your taxes and public services. A government's budget is a balancing act. The more it has to spend on interest payments, the less it has for everything else: hospitals, roads, schools, defense. Some countries now spend more paying interest on their debt than they do on education or health, which directly hits citizens' quality of life. Fourth, it impacts your job security. The entire debt system is built on one thing: confidence. If that confidence breaks, say a government defaults or a major bank collapses, it can spark a financial crisis. A crisis means a credit crunch where lending freezes up, businesses can't get capital, and they're forced to lay off workers. The stability of the job market rests on this debt machine running smoothly. And finally, it shapes your retirement. As we saw, pension funds are some of the biggest owners of government and corporate debt. The returns that fund your retirement depend on the interest paid by these bonds. Long periods of ultra-low interest rates, designed to keep government borrowing cheap, can starve those pension funds, putting your retirement income at risk. So who owns the world's colossal debt? The answer is, we all do. It isn't owed to some single all-powerful entity. It's owned by a vast, interconnected ecosystem. It's owned by the Japanese pensioner whose savings are in U.S. treasuries. It's owned by the American worker whose 401k holds corporate bonds. It's owned by the German bank that buys French debt for liquidity. It's owned by central banks acting as the ultimate backstop. And it's owned by you, indirectly, through your bank, your insurance, and your retirement fund. The global economy isn't really built on money as we think of it, cash in a vault. It's built on a series of promises. A bond is a promise. A bank deposit is a promise. A currency itself is a promise. This massive IOU is the engine that makes the modern world go round. It has funded incredible growth and innovation, but it's a system built on a fragile foundation of confidence. Understanding who holds this debt is understanding where the power lies. It's not a conspiracy, it's a system. A system that links your mortgage to a central bank's policy and your retirement savings to a government's budget. So the next time you hear a headline about the national debt hitting a new record, you'll know it's not just a number. It's another thread being woven into the complex financial fabric that quietly runs our world. If you want to keep exploring the hidden forces that shape our economy, be sure to watch our next video on how central banks actually create money. And don't forget to subscribe and ring that notification bell so you don't miss it. Thanks for watching.